In this video, let's take a look at preparing a Hawaii income tax return. Now, some states do not require an income tax paid by individuals. For example, Texas, Florida, Nevada do not require individual income taxes. But here in Hawaii, if you're a resident for the whole year, then you have to fill out this form N-11. Now, let's say you have Hawaii source income like a business or a rental property here in Hawaii, but you're not a resident here for Hawaii. Then what you would do is fill out a form called N-15 for non-residents, and you would report and pay taxes on the income related to Hawaii source income. Also, if you're a resident of Hawaii and leave the state, become a resident of another state during the year, or you become a Hawaii resident during the year, then you're considered to be a part-year resident for that year, and you would fill out a form N-15 again. But let's just focus on the N-11 form where the taxpayer is a resident of Hawaii for the whole year. Let's zoom in here. So at the top, you would fill in, just like a federal return, the taxpayers' names, their social security numbers, and their address. And just like the federal, just like in Chapter 2, we learned there's 5 different filing statuses. And in the case of married, that includes same-sex couples. Also, here in Hawaii and some other states, there's something called civil unions, and they're considered also to be married, so either they have to file joint or separate returns. The next section here in line 6 is to check off for exemptions. So like we've seen for federal, you can claim one for the taxpayer, and if it's a joint return, one for the spouse. But for Hawaii, if the taxpayer or spouse are age 65 or over, they get another personal exemption. We had learned in Chapter 3 for federal, age 65 or older, the taxpayer would get an additional standard deduction. But Hawaii will give them an additional personal exemption. Down here in line 6, 6C is for dependent exemptions, again identifying the dependents, and then we would take a total of all of the exemptions here at the bottom of page 1 of this Form N-11. Form N-11 is 4 pages long, so this is the end of the first page. We would then start off with the first dollar amount at the top of the next page, the federal adjusted gross income. And in another video, I'll talk about how the rules are different for income and deductions from federal compared to Hawaii. So let's jump all the way down to the Hawaii adjusted gross income here on page 2. We would then subtract out either the taxpayer's standard deduction or itemized deductions. I'll talk about these itemized deductions in our Chapter 5. But here, we would write down the amount of the taxpayer's standard deduction for Hawaii. So in the case of filing status 1 and 3, that's single and married filing separate, and they would get a standard deduction of $2,200. Or in the case of filing status 2 or 5, back on page 1, that's married filing joint or qualifying widow, which is double the standard deduction for single person. And the dollar amount in between the two would be the head of household standard deduction. And just like federal, we would take the larger of the standard deduction or itemized deduction. Again, we'll talk about itemized deductions in a future video. Then we subtract out on the next page the taxpayer's personal exemptions. And for each exemption we had identified back on page 1, we can claim a $1,144 amount. It's such an odd amount. Usually it's adjusted a little bit every few years for inflation, not automatically adjusted for inflation though. And if the taxpayer or the spouse is disabled, in lieu of this 1144 personal exemption, either for taxpayer spouse or age or dependents, the taxpayer or the spouse, depending on who's disabled, can claim a $7,000 disability exemption. Now, that exemption is based upon the taxpayer being blind, deaf, or disabled, meaning they cannot go to work. And that has to all be doctor certified. And you have to file a claim for that ahead of time before trying to report it here. Again, this $7,000 disability exemption is in lieu of the personal exemption for the taxpayer or the spouse, also in lieu of the age, and also the dependents cannot be claimed if you're claiming that disability exemption. Subtracting out the standard deduction from the previous page and exemptions here on this page 3 will give us our tax base, the taxable income that we would look up on the tax table. Again, just like federal, up to $100,000 of taxable income on the tax table. Or if it's higher than that, 100,000 or higher, then we have to use the tax rate schedule. The capital gains of the taxpayer, long-term capital gains, could be taxed at a preferred rate of 7.25%, depending upon the tax rate, marginal rate of our taxpayer. Again, this is for Hawaii. We don't learn about taxation of capital gains until we hit chapter 6 of our textbook. There is no preferred rate for qualified dividends like we see on the federal side. State side, the qualified dividends are taxed at regular rates. So we would fill in our tax based upon what we see in the table or rate schedule. And then we would subtract out, as we learn in chapter 9, tax credits. And we'll cover this Hawaii credits in a future video. The main payment of the tax would be probably through some withholding or estimated tax payment. And if we had overpaid, we can get that back as a refund here. Or if we had underpaid for the year, of course, that's going to be a balance due, a tax owing here. And at the bottom, we would sign off as the taxpayer. If we are mailing in this tax return, and most returns now are probably being electronically filed, but if we're mailing in the return, we would attach copies of the W-2 form or any form showing Hawaii income tax withholdings here. And if we have to make a payment, the check or money order would be attached here with a voucher form called N-200V. This voucher just helps process the payment faster on the state side. So I'll have additional videos to cover the differences between Hawaii income and deductions compared to federal.